Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is going to be TLT. That's the ETF that tracks Treasury bonds, specifically the 20-year Treasury. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie, I'm showing a chart of the S&P 500 index here. And the only real good news is that we have recently set a new high in the SPX. We basically crawled like a toddler to set that new high. So there really hasn't been a lot of activity, but we are at a new high. So you got to have something, there's something good there to mention. Also in the NDX, we just recently set a new high. So we're setting new highs, but we're not doing it with a lot of oomph behind it overall. So what do we see going on in the markets this week, Callie?
Yeah, Brian. Well, cup half full. I like it. I like it. Markets haven't been doing much of anything, but we do have a big week ahead of us. Why? Because it's Fed week, Brian. One of my favorite weeks of the year. Happens 8 times a year, so happens quite a bit. But anyway, it's the Fed. The Fed. The Fed is supposed to announce a policy decision on Wednesday, and Fed Chair Jay Powell is expected to speak after. That's the big headline coming up. And, outside of that, not much of anything's going on. It's the summer. But why does the Fed matter so much? Well, investors are worried about rising inflation these days, and the Fed is the front line of defense against this. Because of this, investors are going to pick apart everything Chair Jay Powell says in his press conference, and any mention of tapering or raising rates could shock the market. Outside of the Fed, there isn't much going on besides the regular worries about inflation, about taxes, about stimulus, the usual stuff. And volumes are low, and the market, like I said, hasn't done much of anything lately. Focusing on today, stocks are down a little on a disappointing retail sales report. The data is a little more concerning than usual because slow retail sales could show that the consumer may not be tolerating higher prices as well as we think. But one data point doesn't make a trend, so I wouldn't dwell on it too much for now, although the market is down a little bit on the back of that data. Retail sales have also been strong lately, so it could just be a quirk of the recovery. We don't know yet. So overall, this week, we're just sitting and waiting for the Fed. To be fair, we'd be shocked if the Fed did make any moves that roiled the market. But the chances for that are a little bit higher than now that we've had 2 strong months of inflation data. And investors, like I said, seem to be a little on edge about anything inflation related. And there isn't a lot of news that could push us meaningfully higher. I mean, Brian, you said yourself, we kind of crawled to a record high. There's a reason for that. There's just not much going on. So going forward, we could continue to be stuck in a range, but we'll see what happens with that Fed meeting on Wednesday. All right, Brian, that's the rundown of what I'm seeing in markets. So tell us what you're seeing in the VIX.
All right, well, the VIX is interesting in that we finally see the futures contracts coming down below the 20 level and coming a little bit more in range with the spot, the actual VIX index. So I'm highlighting my VIX watch list. I'm going to scroll all the way down to the bottom here and show you the VIX. The VIX right now is at 1701. It's up 62 cents on the day. We have the SPX down a little bit, so it makes sense that the VIX is up a little. But what's more interesting to me is that if we go all the way out to the August contract, it has taken forever for this futures contract to get down near the 20 level. We still haven't gone below it. We see it trading right now on the August futures. Now, remember, these futures are what the option expiration for August uses to price those option contracts overall. So the August futures contract is trading at 2080. The July is below that 20 level. It's at 1937. And then we have the June contract that's trading right around 1717. So the futures are finally coming down a little bit more in line with the spot. There's not such a huge dichotomy. And the fact that they're actually going below that 20 level has been a very important level just in general ever since the downturn or since the pandemic announcement, if you will, over a year ago now at this point in time. All right, so today's stock, I'm a little interested to hear what you have to say about it. It's the ETF TLT, showing a little chart of it, and I'll just kind of highlight something that's happened in the chart a little bit. Is that we actually did have a little bit of a breakout here at the in June. We had a breakout to the upside a little bit in the TLT, but now we're coming back down and we're testing that area of support. So, what do you see with the 20-year Treasury going forward, Callie?
Yeah, Brian. Well, I prefer you call it the TLT because that helps me make so many puns. By the way, whenever I think of TLT, my mind always goes to that AC/DC song called TNT, TNT. Yeah. So now it's stuck in my head and it'll be stuck in your head all day. So you're welcome, viewers. Anyways, TLT, the ETF, is an ETF that is built to track prices on treasury bonds with maturities of 20 years or longer, like Brian said. And remember, little bonds 101, when bond prices go up, treasury yields tend to go down. So when yields, like I said, when yields go up, prices go down. I was going to say the reverse, but couldn't get into it. Anyway, bond prices move in the opposite direction of bond yields. And to add another layer to it, rates also tend to go up when inflation is increasing. So a lot of things are going on and they all could be interesting for TLT, especially around the Fed meeting, like I was talking about earlier. So the Fed isn't expected to change policy. We're not expecting it. The market isn't expecting it. But Chair Powell could have a tough time talking about a weak economic recovery in conjunction with pretty high but transitory, as people are saying, transitory inflation. But it could be hard to make the case for that after 2 straight core CPI readings of 3% growth. While that doesn't sound like a lot of growth, it is strong growth for inflation. It is historically strong. And that's why there's a higher expectation that the Fed will have to at least start talking about or mentioning tapering or raising rates sometime soon. Generally the market thinks that tapering will happen before raising rates. That's what happened in the last economic cycle. But even if the Fed starts mentioning the word tapering, that's a step forward from where we are right now. So anyways, the Fed may allude to higher inflation on Wednesday. And if that happens, that could spook the stock market. But what about the bond market? It could also lead to a pop in long-term bond yields. And that's where TLT comes in. Now, some background on treasury yields. They're still historically low, the 10 years around 1.5%, but they've climbed a lot this year with expectations for stronger growth and higher inflation. However, they have cooled off a little bit in the past month, and that's led to TLT, our ETF, rising to a 3-month high. Because if you remember, again, yields climb, bond prices drop, yields go down, bond prices go up. Yields are down right now over the past month, and prices are up for a bunch of different reasons. But this is happening at the same time that inflation worries are increasing. And inflation worries have arguably been the biggest catalyst for yields going higher. So put all of that together, and we could see TLT sell off quickly if the Fed surprises the market by changing its stance on inflation or policy. And even past the Fed, if inflation data continues to come in strong, if worries increase, then we could see TLT drop off at a point further out than the Fed as well. So to be clear, the data still does show that rising inflation is transitory so far. When I say transitory, it means we might not, it might be temporary. We might not see it continue past this summer. It's just a weird spot in the economy. And we believe that's the case. We believe that this is an inflation spike that could fizzle out through the second half of the year. But inflation is tricky. It can be a self-fulfilling prophecy. You might, see prices rising at the grocery store and say, I don't really want to spend my money on that avocado or that orange or that, pack of coffee or something. And, that means that spending goes down. So that's how it can be a self-fulfilling prophecy. And, it's hard to understand how to navigate this environment because we haven't seen inflation like this, significant inflation, in over a decade. So overall, it may be time to start preparing for an inflation storm, or at least looking for opportunities that high inflation could lead to. And that's why we're looking at TLT today. All right, Brian, thinking about TLT, we need an options trade that hedges or calls for a jump in yields and a decline in bond prices. So I want to hear what you have for us there. But before I pass it over, I'm going to ask our viewers to drop your questions in the chat. Drop your questions in the chat because at the end of the show, Brian and I will be answering your questions live. All right, Brian, I've talked enough. So tell us about what you see in TLT options.
All right. Well, as always with Options Playbook Radio, it's more about picking the strategy. Nothing is, or Options Playbook Radio, with the stock play of the day. It's more about picking the strategy based off of what the pricing is in that underlying, not necessarily meant to be a recommendation overall. So now I have the Options Playbook up, and the trade that we're going to look at is a short call spread. Now, recently on Stock Play of the Day, a lot of the stocks that we've been talking about have had more volatility than less. In other words, the stocks had higher volatility than the general marketplace. This is not the case with TLT. Implied volatilities are fairly low, and you just look at the chart, there's still not a lot of movement in general on that chart. Specifically more recently over the last couple of months, we really haven't seen a big deviation from the highs and the lows day in, day out, and month in, month out. Okay. So with that said, we're going to try to be bearish. We're going to sell a short spread, but we're going to go out further in time because of the dynamics of the option prices in this ETF. So if with the short call spread, we're going to bring a net credit into the account, and we're hoping to capture as much of that net credit as possible. So our risk is going to come from selling strike A. That's going to be the nearest to where the underlying stock is at. And then we're going to hedge by buying strike B, and that's going to be our protection. It's going to limit our risk to the difference between the strikes. We'll be out of the money, so we're going to have a little bit of play in this, and that the underlying could actually go up a little bit, and we could still be profitable on it. But ultimately, we'd like the market to at least stay where it's at or drift lower in general. And so that's the goal. So that's the strategy. So let's look how this plays out inside the Ally Invest option chain. So let me scroll up to the top and show us where we're at. Last trade in TLT is 140.77. It's down 45 cents on the day. We're going to go out to the 45-day to expiration, the July 30th expiration. That's 45 days away. Now, I'm not planning on being in this for 45 days. That's usually not the goal. But when you have a little bit lower volatility, I would prefer to go out further in time and still treat it as a short-term trade. In other words, I want to be out of this trade within 2 weeks, 20 days max, 3 weeks max, to be in this trade. And then I would want to close it out. Now, obviously, it all depends on what's going on with the pricing. But if I go out further in time, I can bring in a little bit bigger credit. And then that also allows me time to adjust the trade if the trade were to go against me. So I like the 45-day period specifically on underlyings that don't have a lot of implied volatility in general. So I've talked about this trade a lot. And one of the underlyings that I've talked about it in is the SPY, the S&P 500 index, which is an index that is fairly volatile, but we're still looking at like the VIX right now trading at around 17% implied volatility. That's definitely a lower volatility for a stock. Here in TLT, we're actually at a 12% vol. Look at this. I'm going to highlight the at the money call here, and we're trading right around 12%. So we're even lower than what the actual VIX index is. So moral to my story is, if you want to trade lower implied volatilities, I prefer to go out further in time, bring in a little bit of a credit, but still treat it more as a shorter term trade. Okay. So we're going out 45 days, but we don't plan on staying in it 45 days. I don't know how many different ways I can say it. So there we have it. Okay, so here's our trade. On the left-hand side, we have calls. We see that expiration. We check the box once for buy, twice for sell. We're selling the 144 strike call. So we're giving ourselves a little bit, the stock can go up a little bit, and we're still going to be okay on this, as long as we get enough time decay. And then we're going to go out and we're going to buy the 146 strike call. So if we scroll down, we see we get this entire trade done. We're going out 2 points. So we're limiting our risk. The maximum this could trade for is $2. And we're going to bring in about 42 cents on that trade. So Overall, we're looking at about $1.58 is going to be our maximum risk on this trade. 42 minus 2 overall. So that's the risk, that's the reward. If I'm selling this for 40 cents, though, like I said, we're not going to ride it all the way to expiration. If I can buy it back at 10 cents, 15 cents, I'm going to do that. I don't want to try to eke that last dime out because it's really not worth it, especially with an underlying with such low volatility overall. Just get out of the trade and move on if you are profitable. Now, if it goes against you, you can say to yourself, well, it's trading for 80 cents. Basically, the maximum I would have made, I could close this out, or maybe 70 cents in that range. So those are going to be my dynamics. I'm going to put the trade on, and that's how I'm going to approach it. So let's make it the official paper trade. I'm going to put it in the right rail. And here's what we're looking to do. We're going to be selling to open one of the July 30 expiration 144 strike calls, buying to open one of the July 30th expiration 146 strike call. We're going to go for a net debit. We're going to go for the midpoint. These are fairly liquid options. A lot of these treasury ETFs trade fairly frequently, and the options are pretty liquid in general. But we'll do it right at the midpoint of 42 cents. We're going to have to work that. It's never a guarantee. And don't forget, we got to add commissions onto this trade overall. But that's going to be our maximum upside is 42 cents. Our maximum downside is going to be 42 cents minus $2 or 158. All right. So now let me take a quick peek at the profit and loss graph inside Ally Invest here. All right. So we see where the underlying market is at. Now, obviously, if the market drifts down, well, then it's a no-brainer on this trade overall. Just let the market drift down, let time decay work for you. After about 20 days or so, if that is the case, you'll be able to close it out for 10 or 15 cents. We close it out, we move on. Market starts going on up. Well, we don't have any risk until we get to this 144 level. And then our risk is from 144 to 146. Now, in general, my general rule of thumb is I might close it out based off of the price of the spread, right? I'm trying to bring in 40 cents. That's the maximum I can make. So if it's trading for 70 or 80 cents, I'm going to close it. I'm going to minimize that loss. Or one way that I always look at it too is if it ever gets to 146, my long strike, I just like to close out my short spread. It's gone against me enough. That long strike actually has some premium in it. It's an at the money option contract, and that's where all that juice tends to settle. So it gives me the most bang for my buck as far as my hedge is concerned to protect me. So if it does get to that level, I usually will close out a long short spread, no matter what is going on with that situation, right? I obviously was wrong on my forecast. If it's gone all the way up to my short strike and beyond, all the way up to my long strike for sure. So those are just a couple of rule of thumbs in trading short spreads in general. All right. But overall, if I'm doing this trade, I'm neutral to bearish on the marketplace. It can drift a little bit higher, but time decay is my friend in this strategy overall. All right, Callie. Any questions that we have so far?
I'm not seeing many questions in the chat. Ibrahim Shalabi says hi. So hi, Ibrahim. So question for you, Brian.
Okay.
I'll throw it in there. I'll jump the line. So why did you pick this particular expiration for this trade? Why 45 days out?
Okay. So that I guess we kind of emphasize that a little bit, but let's just compare it to doing a shorter term trade. If we're doing a shorter term trade, and let's say we're just going to do a 20-day trade like we were talking about, if I do that, I'm going to have to get closer to the money. I'm going to have to get closer to where the actual underlying is trading and to get the same amount of premium, right? So I got to move my strikes in a little bit towards where the underlying stock is at. And so I don't have as much room, first of all, for the underlying stock to move. And second of all, if it does move against me, there's really not much I can do about it. I'm just going to have to close out the trade and move on. And that I can adjust the trade because time premium is going to erode and it's going to, then once time premium starts decaying and going away from the options that I've sold, that means the options around it also have time decay. So it makes it really hard to adjust it, to either roll it out in time, to roll it into maybe a butterfly or a different type of trade overall. So in particular, when we're talking about an underlying that's trading at a 12% implied volatility for the expiration that we chose, well, then I like to go out further in time. It gives me a little bit more of a buffer for where the underlying stock is versus the short strike. And then also, if it moves against me hard in the right away, that time value that is in those option contracts can allow me to adjust and allow me some protection overall. But good question overall, Callie. Any others that popped up in that chat box?
Brian, I'm not seeing many. Actually, really surprised that Wayne isn't on here. So, Wayne, holler at us.
All right. Well, we are a little bit early here. We're going to be closing the show at a little bit before normal time, I guess. But overall, I guess we'll just move on, and I'll let you talk a little bit about the overtime.
Yeah. Well, I'll take us out. So, thank you for joining us today, everybody. Brian mentioned overtime. We do a stock play of the day overtime every Friday at 12 p.m. Eastern, just to revisit the trade and, see how well we're doing, see if we need to make any adjustments, anything like that. So please join Brian at 12 p.m. Eastern on Friday for stock play of the day overtime. Oh, we have a question. You want to take it?
Well, we got time. Yeah, let's do it.
All right.
I don't have the chat box up, so I can't really see what's going on right now.
Yeah, all good. Oh, and I see Wayne too. Wayne coming through. Okay, so first question is from Godfem. I'm so sorry. Godfem. Hey, Godfem. So Godfem says, I'm new to options. If I choose a certain date, do I have to hold out until that date, or could I cash out before?
All right. So ideally, when you're doing short spreads, a lot of people may wait until that expiration, but no, you do not have to wait, and most people don't. Very rarely do option traders actually even buy long options and hold them all the way to the expiration date. As a matter of fact, I'm going to show my screen here, and this is one of the more popular pages inside the Options Playbook website, and it's called Cashing Out Your Options. It's a one-page read. It's very simple. It's very straightforward, talking to you about your 3 different things that can happen if you're a beginning option trader. You can close it, you can let it expire, or you can exercise if you're long. Then also the next one that I would highlight, besides cashing out your options, is keeping tabs on open interest. Open interest isn't a term that you use with stocks, but it goes hand in hand with cashing out your option contracts and how they keep track of the actual contracts that are out there that are available to be traded overall. So 2 little short reads inside the Options Playbook. And we know, because we just ran some numbers on the website, that these are 2 of the more popular pages inside the Options Playbook website overall. So great question, and it allowed me to kind of toot our horn for optionsplaybook.com.
Yes, gold star for you, Godfem. All right, well, we have a question from Wayne. Wayne says, hey, Callie, and he has a question for you, Brian. Okay. He asks, Brian, if we want to bring in more premium, is it better to add more contracts or widen the spread? Even though both of those choices will increase our risk, which is a better choice?
That is a great question. So Wayne is basically saying that right now we're doing a 2-point wide spread, and we're bringing in about 40 cents, a little bit more, but we'll call it 40 cents to make the math simple. What if we did a 5-point wide spread and we brought in 80 cents? Now, does that make more sense than doing adding an additional spread to the shorter spread overall? And now the biggest trade-off here is your risk point. If I do 2 of the 2-point wide spreads, right, my risk kicks in sooner. So ideally, if I'm doing that, that means that if it gets to 146, then I have no more protection. My long put doesn't help me as much. So if I go a little bit wider to bring in the premium, you should receive a little less premium. Why? Because the stock has to move more in order for you to be a big loser on that trade. So it is all about trade-offs. If I do 2 of the shorter ones, or the shorter width ones, I should bring in a larger credit than making it a little bit wider overall. So those are the trade-offs. You can decide, but the benefit of going wider is obviously the stock's got to go up more on the short call spread before you lose the maximum on that trade. Great question once again, Wayne. Thank you for asking.
Yeah, and great question. I agree. That one made me think too. All right, one more question and then we'll wrap things up.
Okay.
So Neil Gerst, hey Neil. Neil asks, I know this is options focused, but what do you think about TBT as a hedge? Well, first of all, Neil, we will answer any and all questions on here, with some exceptions because otherwise compliance would slap us on the wrist. But we will definitely talk about more than just options on here. So I'm happy you asked that question. TBT, for everybody watching, TBT is actually an ETF that is kind of the inverse of TLT. It's issued by a different company. It's ProShares, but it's the ultra short 20-year bond ETF. And I'll be honest, I haven't studied it a lot. I know of it, especially from my days several years ago and when I was writing about more bond markets. One thing I will throw out there, having not studied TBT, but just in general, if you're using ETPs or any type of ETF or ETN as a hedge to something, you need to know about the fees and the expense ratios and how the fund actually works. That may seem very obvious, but funds, especially ones that buy and sell futures, buy and sell contracts to kind of mimic another contract or mimic a strategy, they have some inherent costs outside of fees too. They have roll costs sometimes. They have, friction. You have to think about, how that ETF trades to its net asset value, how it trades to its intrinsic value. There are a bunch of different things you need to consider when looking at an ETF or ETP in general to hedge. And I wouldn't be surprised to see a few of those things work into TBT as well. So I couldn't tell you if it was a perfect hedge. I mean, on the face, the strategy does seem like a hedge. But TLT is a long 20-year bond. There are other ways to kind of hedge around what TLT is moving on to. Like, of course, TLT is long bond. Stocks and bonds typically move in the opposite direction, although they're not doing that these days. So TLT almost can act as a hedge for other things for your stock portfolio. So I know that's a lot, but there are a few things you need to think about when looking at other ETFs to hedge TLT. So I know this is what everybody says, but do your homework.
I could
Yeah.
add one thing to that. Just one of the simple things to do is to just look at both of them on a chart. Pull up a 6-month or 1-year chart and just look at at how they track each other. How TLT, what happens when TLT goes up, and what happens when TBT goes down overall. So just take a peek at it, look at it that way, and see how that works. But everything that Callie talked about with ETNs and expense ratios, they just don't always do exactly what you expect them to do when the actual underlying moves, because of a lot of these fees and ratios and how they have to roll the positions, et cetera, et cetera.
Yep. See, Brian saying everything I tried to say in a much better package. All right. So we'll wrap it up there, Brian.
Right.
I know we threw this out a few minutes ago, but please join us for overtime on Friday. Brian will review today's trade and, let you know how we're doing, see if we need to make any adjustments. That's at 12 p.m. Eastern right here on Ally's YouTube channel. So join us for that. And Brian, I'll let you take us out.
Right. And I want to mention on June 23rd, we're going to have an all-day digital conference that you're going to want to sign up for. And so basically, if you click subscribe and ring the bell, you'll get some information on all of our events inside the Ally Invest YouTube channel. So make sure you do that. And please check out our digital conference that's going to be on the 23rd, starting at 10 a.m. Eastern time. I think that's when we're going to be kicking it off. So thanks for coming, everyone, and we'll see you this Friday on the Stock Play of the Day Overtime. Bye, everyone.